Okay, so have you ever wondered what really makes a trader successful? Beyond just picking the right stock, it's often not quite what you think. And today, we're taking a deep dive into exactly that. We've got a stack of insights here from the latest TradersWorld magazine, that's issue #92, for April, May, June 2024. And this isn't just about market predictions, it's more about the underlying principles, the psychology, and maybe even some hidden science that top traders are digging into.
Right. And what's fascinating, I think, is that these sources we're looking at, they don't just give you tips. They really challenge some fundamental assumptions about how markets behave. It reveals a really multifaceted approach. So our mission today basically is to pull out those core nuggets for you, everything from, believe it or not, ancient wisdom, right up to cutting-edge AI, to show you what truly matters for success.
Okay, but before we jump in, it's really important to remember the crucial disclaimer that Traders World always emphasizes. Futures and options trading, well, they're highly speculative. They involve substantial risk of loss, big risks. Past performance, whether it's actual or simulated, it just doesn't guarantee future results. You have to remember that. So, this deep dive is purely for informational purposes. We're here to help you understand the concepts discussed, not to endorse any specific trading activity. Always be aware of the risks. Only trade with money you can truly afford to lose. Okay, right. Disclaimer done. So let's get into it. It's really interesting. Many people jump into trading thinking it's like all charts and numbers. But our sources today really highlight that the true battlefield, it's often within yourself. It's a fascinating pivot, really.
Absolutely. Alexander Stracker, in his piece, To Be or Not to Be, it is up to me. He gets straight to the core of it. He says emotionally driven errors are the biggest culprit behind most trading failures, full stop. So consistency in your strategy and disciplined risk management are just imperative, non-negotiable. Stracker really stresses know thyself because your internal state, whatever it is directly bringing about your outcomes. Which, raises that important question. If your mindset is that big a factor, how do you actually go about cultivating the right one?
Yeah, that's the million-dollar question, isn't it? How do you do that? Straker brings in Bernard Baruch. Now, he's maybe lesser known than someone like Gann, but his insights are just as relevant, I think. Baruch's principles for managing that inner game, they sound simple, but wow. He advises you to only speculate if it's your full-time focus. That's a big one. Ignore inside information, which, let's face it, is probably just noise most of the time anyway. Really understand a company's fundamentals. Cut your losses quickly, don't let them fester. And critically, never invest all your funds. Always keep a cash reserve. He also suggests focusing on just a few stocks you really know well, reviewing things periodically, and yeah, thinking about your tax position too. What really stands out to me there is the sheer discipline involved. Those sound simple, but they're hard.
Oh, definitely. And that discipline, it's echoed by Steve Whaler in the #OneVital approach. He really reinforces this mental game aspect. He breaks it down into, I think, 6 critical areas. Emotional control, discipline, and patience. He links those to how you deal with loss. Overcoming your own biases, managing stress, and crucially, continuous learning and adapting. Wheeler suggests that finding that emotional control, it involves becoming organized, building your skills, and be actually confident in what you see in the market. And he explicitly states that emotionally driven mistakes, what he calls trading errors, are, well, hands down the most costly mistakes you can make.
Right. So for you listening, what this boils down to is that developing a resilient trader's mindset isn't just, a nice side project. It's absolutely essential. Wheeler even gives a clear blueprint, a comprehensive futures trading plan template. It covers everything: your goals, risk tolerance, market analysis, entry-exit rules, and even the psychological prep, like having emotional management plans, daily rituals, stuff like that. It's all about having that solid plan and then, well, the hard part, the discipline to stick to it, avoiding those impulsive moves. And he points out how technology can help here too, like using automated trailing stops or setup identification tools, things that can take some of the emotion out of the execution.
Exactly. And speaking as emotion, dealing with loss. It's just inescapable in trading, isn't it? Wheeler urges you, though, to view losses as learning opportunities, not as failures. That shift in perspective, it's absolutely vital for long-term success. It lets you refine your strategies, improve your risk management, instead of just getting bogged down by the monetary hit.
Yeah.
So a critical point this brings up is, are you truly extracting lessons from your losses, or are you kind of letting them define your whole trading experience? Big difference.
Okay, so we've talked mindset. But beyond the mind, how do markets actually work? Is there some underlying order, or is it just, chaos? Our sources explore some really fascinating perspectives on this, from the ancient to the really cutting edge.
Yeah, William Bradstreet Stewart in the financial markets as a scientific laboratory makes a really compelling case. He suggests markets can actually serve as a testing ground for these grander theories like cosmological economics or um, Gann's law of vibration. The whole idea is to try and prove whether there is a predictable order governing financial markets, which of course directly challenges the standard random walk theory that says prices are basically unpredictable. And Stewart highlights W.D. Gann's incredible 92% success rate, not just as some forecasting magic trick, but as actual proof of a well-designed strategy and the value of technical analysis.
That 92% from Gann, it sounds almost unbelievable, doesn't it? Legendary. It makes you wonder how that translates to, well, practical terms. Stewart breaks market action down into just three simple variables, all driven by mass human psychology, according to Dr. Jerome Baumring, basically. Hope leads to buying, so upward movement. Fear leads to selling, downward movement. And indecision, sideways movement. It really simplifies the huge complexity down to these three fundamental human drivers. Quite elegant, actually.
It is elegant. And then what's truly intriguing is Dr. Laurie Van Bennett's work. It's called The Seasons of I Ching in Forecasting Markets. Talk about a unique perspective. She suggests going back over 5,000 years to the I Ching, the ancient Chinese book of changes, suggesting that could provide a trading edge. She apparently found correlations between these I Ching hexagrams and time cycles, the zodiac, and even W.D. Gann's own ideas on market seasonality. And she gives examples, like projecting trend changes in gold and wheat using these, well, ancient principles. It really makes you wonder, doesn't it? Can millennial wisdom actually hold useful clues for today's markets?
Okay, ancient wisdom. Fascinating stuff. Now, let's maybe bring this into the 21st century. Let's see how these timeless ideas might intersect with modern tools. Thomas Barman of Never Lost Trading, his focus is on maximizing trading results by acting at crucial price turning points, free. So his approach is all about pinpointing those exact moments of supply and demand shifts or increased trading frequency or clean breakouts from price patterns. Very precise.
Right. And Never Lost Trading, according to Barman, integrates some pretty advanced AI and machine learning right into its indicators. This apparently allows their systems to adapt dynamically to what the market's actually doing and make these complex, nonlinear predictions. They even claim 70% plus accuracy in forecasting, which is a bold claim. What's particularly interesting, I think, is they explicitly state they don't use natural language processing or sentiment analysis from, like, Twitter or news headlines. No, instead, they operate on the premise that the crowd follows the leaders. So their systems focus on tracking institutional money, big money moves. They use a fractal-based model for price movement, seeing patterns repeat at different scales, not fixed cycles. And they really emphasize a risk-to-reward ratio of 1.2. They argue that significantly boosts long-term profit, even if you don't win every single trade. Okay, so understanding the market, mastering your mind, foundational stuff. But how do you actually, translate that into a practical, repeatable trading approach? That seems to be where systematic design comes in. Exactly. And Sunny J. Harris, who has, 43 years of experience in system design, she makes it really clear. A trading system is simply a recipe or a map, for buying and selling. That's it. And for her, a system works if it makes a profit consistently. Simple definition. She introduces her own metric, the CPC Index, Consistent Profitability and Consistency Index. It's a measure of how robust a system is. You calculate it by multiplying your profit factor, your percent profitable trades as a decimal, and the ratio of your average win to your average loss, her rule of thumb. A CPC Index of 1.2 or higher means a system is probably tradable. And she highlights that some systems might look good on a chart, visually appealing, but they might not actually meet that profitability threshold.
That's a good point. Visuals can be deceiving. Harris also talks about PHW analysis profitable high wave, which sounds complex, but it basically helps you calculate the theoretical maximum profit you could have made by catching all the highs and lows in a certain period. It's about figuring out where's the money for the potential money in a given market and time frame. She gives a great example with the M&E S&P futures, showing how, say, a 15-minute chart, even though it has fewer price points, it could actually end up being more profitable than a 5-minute chart once you factor in commissions and slippage. Those costs add up, which raises a really important point for you. Are you really analyzing the true costs and potential returns in different time frames for your trades? Because the devil's often in those details, isn't it?
Absolutely. And Harris is wonderfully pragmatic about actually making money. She says flat out, it's physically and emotionally impossible to catch every single high and low. Forget about it. Instead, she advises breaking down those big, ambitious financial goals into manageable daily targets. Like her example, to make $1 million a year, you need to aim for roughly $3,849 per day. That approach makes a huge, daunting goal feel, well, achievable, step by step. And she emphasizes, without a clear plan like that, you probably won't get there.
That daily target idea, that's such a powerful way to reframe things, makes it less overwhelming. Okay, shifting gears slightly. DK Burton offers this fascinating glimpse into how to learn WD Gann from the beginning.
Ah.
He emphasizes that Gann himself apparently suggested reading the first 62 pages of his classic book, How to Make Profits in Commodities, like 10 times. 10 times, just to really grasp its depth. Burton advises hand charting prices, starting with monthly charts as your main trend indicator. He says monthly charts are 30 times more important than daily charts. Wow. Which really harks back to Gann's focus on the long-term health of the market, suggesting you should maybe only trade 3 or 4 times a year, allowing for deep research rather than getting caught up in the noise of day trading. Very different perspective.
Very different. And then finally, there's Rob Mitchell's 100 Concepts for Exceptional Traders. These are short, sharp, really thought-provoking ideas. And he suggests any one of them could significantly improve your trading. For instance, he talks about knowing where and when not to trade, which, let's be honest, is often harder than knowing when to trade. He emphasizes trading for edges with high probability. Makes sense. And his 100% axiom, this idea that there's almost always a better trade coming along than the one you're currently looking at, helps curb impatience, maybe. And this prompts a crucial question he raises. Are you trading what you genuinely see based on your plan, or are you just chasing what someone else says they see? Big difference. He also makes that powerful point. Believing is seeing in that order. And that both your rational mind and your intuitive mind, they have to be in complete agreement for real success.
That idea, believing is seeing, that sets us up perfectly for our final section, I think. How do you actually reconcile all this? The hard science, the logical systems we've talked about, with that more elusive gut feeling, the intuition that so many successful traders seem to rely on. Where do those meet?
Yeah, Sergei Tarasov, who's actually a former scientist, delves right into this in The Apology of Common Sense. It's a great title. He notes this historical trend, of scientists moving into finance, bringing these incredibly complex mathematical models, but often with, frankly, disappointing results in the real world. His core argument is that people often fail to distinguish between formal techniques, which are logic-based, certain mathematical and non-formal techniques, which are more intuition-based, probabilistic, based on experience. He strongly advocates for using both. He says understanding when your formal, logical approach isn't working should actually be a trigger. A trigger to switch gears and lean into your non-formal approach, your intuition.
Okay, but why wouldn't the formal approach always work? He highlights a key statistical challenge, right? For classical statistics, you typically need a decent sample size, like at least 30 observations to be really confident. But in stock market cycles, within a reasonable time frame, you might only see, 4 to 7 full cycles, sometimes fewer. Which means that heavy mathematics, the complex stuff, it isn't always applicable or reliable. You just don't have enough data. So you're kind of forced to rely on common sense, on pattern recognition that isn't strictly statistical. He gives that example with a 27-day crude oil cycle, only seen 4 times. Formal math just isn't sufficient there.
Exactly. And what's really captivating is Tarasov's concept of magna magnetum, the great unknown in markets. He discusses how certain phenomena, like, say, moon phases seemingly correlating with crude oil movements, things that aren't scientifically explained yet, well, they simply can't be ignored if they appear to consistently offer some kind of edge. You'd be foolish to ignore potentially useful data just because you can't explain why it works. And then he connects this to brain evolution in this amazing way. Our logic-based brain, relatively new, maybe 5 million years old, but our gut feeling, our common sense, which is rooted in really ancient brain functions related space, time, orientation, quick decision-making that dates back maybe 70 million years. Staggering difference. This implies our intuition holds this vast, deeply ingrained database of survival information honed over millennia. He even playfully suggests that maybe our gut feeling for markets is like the accumulated subconscious wisdom of millions of years of lucky pre-escaping predators, that innate ability to sense patterns and danger.
Wow. That's that's a truly profound thought, isn't it? Our ancient survival instincts potentially helping us navigate modern markets. So wrapping this up, what Terrasso seems to be arguing is that to really survive and thrive in the market, you need both sides of your brain firing together, working in concert. The logic gives you the tools, the structure, the experience analysis, and the common sense, the intuition, taps into millions of years of evolutionary wisdom about patterns and risk. It's about knowing when to apply those rigorous rules and when to maybe listen to that deeper, faster intuition, finding that balance. So today we've taken a real deep dive into this, multifaceted world of trading success, pulling apart these fascinating ideas from Traders World magazine, we've seen pretty clearly, I think, that it's not just about market charts. It's equally about your mental game, your psychology. It's about the robust systems you build, whether they're rooted in ancient wisdom, which is amazing, or powered by cutting-edge AI. And ultimately, it seems to come down to finding that harmonious blend of cold, hard logic and that deep-seated intuition.
Yeah, I think that's right. You should now have some solid insights on navigating those psychological battles, which are often the hardest part. Understanding some of the scientific and maybe even philosophical underpinnings of market order or perceived order. The pragmatic realities of designing trading systems that actually work based on metrics like that CPC index. And importantly, the often overlooked power of common sense and intuition. It's definitely clear that true success in trading seems to involve a really holistic approach. It integrates self-awareness, rigorous planning, discipline, and keeping an open mind to patterns and influences that maybe don't have a formal scientific explanation just yet.
Okay, so as you reflect on this deep dive we've taken, maybe consider this final thought. If the market truly is, in some ways, a reflection of mass human psychology, hope, fear, indecision, and if our gut feeling, our common sense, is potentially a product of millions of years of evolved survival instincts, what new patterns, what new insights might you discern by learning to listen more closely to your own deeply evolved common sense, working right alongside the most advanced analytical tools you have? Something to think about.